All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3. And hater of overhyped stocks that are going to have you selling your butt down at the truck stop in retirement. Now today, we're going to talk about Square Incorporated, one of the hottest stocks that has ever existed. Now, I've done two things, and we're going to go through both. I've pulled up the company on Morningstar because I have a free subscription from my library. It's delicious and superstitious. And I've made a delicious, superstitious, cockalicious Excel sheet that shows you, based on what growth rate assumptions and revenue and what projected price to sales multiple in the future, whatever you want to use, what your potential return could be, assuming there's no share dilution. So let's start and look at the numbers in Morningstar. Now, what I like to look at is cash flow from operations, and you can also factor in free cash flow. And you want to look at cash flow from financing activities to see, is the company diluting its current shareholders? Is operating cash flow growing? Is free cash flow growing? Because at the end of the day, the money that you're going to get from the business as an investor is whatever the company can pay out to you in a dividend or use to buy back shares, which comes from free cash flow. So at the end of the day, to me, that's very important. You could disagree. You could just only care about revenue growth, but I like to see profitability and the ability to pay me a dividend one day. Now, looking at Square's cash flow, okay, they have operating in blue, investing in red, and financing in orange or whatever. Let's zoom in a little bit more. So what scares me about this company right off the bat, God, this interface is terrible. What scares me about this company right off the bat is operating cash flow, which is the money they actually make from their business, has been flat. So even though they have this massive increase in revenues, a lot of it's from Bitcoin, by the way, their operating cash flow hasn't grown proportionally. That's the first thing that scares me about this company. Are they actually making a lot of money from operations? Doesn't really look like they are. On top of that, you see this explosion in financing. What that tells me is they're probably issuing stocks to raise more capital to expand the business. Not necessarily a bad thing, but it dilutes the current shareholders. You want to keep that in mind. So right off the bat, just looking at this, no, I don't like it. I see flat operating cash flows and I see an explosion in financing. Doesn't mean the company's terrible, and it doesn't mean you can make a lot of money off of it in the short term, but if you think about it as owning a business, you're not really making that much money off of it. Now, you can also look at additional metrics on Morningstar. And what I like to look at is operating cash flow, like I said. So you can actually see the more details here. So in 2012, they had negative 43 million, it looks like, in operating cash flows. And then you see over time, it eventually becomes positive in 2015. But what I don't like is it almost seems like it peaked in 2019 and then went down in 2020. And it's going down even more over the last 12 months, going into, 2021. So that right off the bat tells me they're burning a lot of cash. They're not really making a lot of money. Now you look at their free cash flow per share, which is how much free cash flow can be used to be paid out to you as a dividend and to be used for share buybacks, both of which, reward the shareholders in a different way. One's tax inefficient, one isn't. Free cash flow per share. I mean, I don't really see any crazy growth. Negative 2.1, 0.11, 0.28, 0.18, 1.21, and 0.46. And it looks like over the last 12 months, it's probably negative. I mean, to me, that's not encouraging. I don't care how fast the revenue is growing. You can make $1 zillion in revenue, but if you're not profitable, the company's trash, okay? So that's it. I mean, it's a growth company, but you can also look at things like, net margin, return on assets, return on equity, return on invested capital. And that kind of gives you a bunch of different perspectives of how profitable the company is. So, I mean, they're not horribly low, but then again, they're not astoundingly high. Now, let's go look at this delicious Excel sheet that I made for you. And maybe one day I'll upload this so you can criticize my Excel sheets. But what I did was, on the top left, I put Square's current market capitalization, which is $110 billion. And then I put Square's revenue, which is $9.5 billion. And I calculated the compounded annual growth rate of revenue over the last year, 2 years, 5 years, and it's actually 8 years, not 9 years. And I also did update Tesla That's what I did last time, but this is actually Square's information, okay? Trust me. So the current price to sales ratio of Square is roughly 11.6. This is using 2020's revenue, so maybe that's changed a little bit. But what you can do with this chart, this beautiful Excel sheet, is pick a projected growth rate that you think Square's sales are going to have over the next 10 years. This is looking at 2020 and then projecting growth all the way to 2030. And then you can project what kind of price to sales multiple Square will be trading at in 2030. Now that's freaking 10 years down the road. That's really far away. But that's what you have to do when you're picking investments. You have to say, okay, are my projections rational, and is my projected price to sales ratio rational? Now, if you kept the current price to sales ratio of 11.6, I mean, yeah, this company's kind of a no-brainer. It's going to make you a freaking fortune. But if you believe that price to sales ratios are really high and you want to use a much lower multiple, maybe looking at the average of the S&P 500, which is like 1.5, or maybe give it a little bit higher price to sales multiple because it's a technology type company, you can do that. But what this chart does is it shows you based on what percentage growth in revenue and what price to sales multiple this company will have in 10 years. It shows you your compounded annual return. Now, I've highlighted in green every return that is greater than 10%. The reason I did that is because on average, the stock market returns 10%. So if you don't think, based on your assumptions, that you can beat the stock market, you wouldn't want to buy an individual stock because you're taking on a ton of risk when you could just buy a freaking index. So looking at this, the first way that Square could beat the stock market as a whole using, historic averages is if they got a 28% compounded annual growth and their price to sales multiple was 3 in 2030. Now, ask yourself, is that reasonable or is it not? Now, at the best case scenario, if Square has a 50% revenue growth rate over the next 10 years, compounded, and the price to sales multiple is 3, you'll make 29% compounded on your money, which is a massive freaking return. I don't think the company is going to grow at 50%, or at least its revenues by 50%. Now, you may look up here and be like, strong man, look at these revenue changes. It's like it's going up every year. It's just growing and growing and growing massively. Well, if you didn't know, a huge part of this revenue growth, and what they had $9.5 billion in revenue, a huge part of that growth was from fees from Bitcoin transactions. I'm not confident about cryptocurrency's future. I don't think it's used as a currency. I think it's used for people just to trade and gamble. And I believe central banks will eventually ban it and just create their own cryptocurrencies. But that's besides the point. But a huge part of this revenue growth came from Bitcoin transactions. So if you believe Bitcoin's the future and you think people are going to be just continuously trading Bitcoin and paying massive fees for it, okay, maybe you can use a higher revenue growth rate assumption. But this 100%, this doubling in revenue over the last year, most of it from Bitcoin, I'm not a fan of it. I don't agree with that. I would use a much lower, sales growth rate, maybe 30% over the next 10 years, maybe 35% if I'm being nice. And then I would maybe use a 2 to 2.5 price to sales multiple. But you can use this chart and kind of figure out where you want to go. Now, in conclusion, I am not a fan of this stock. They make a lot of money from Bitcoin, and I don't believe in any companies that make a lot of money from Bitcoin. I'm not a cryptocurrency fan. And I just think I could probably do just as well in an index fund. To me, it's not worth the risk to potentially make, 14% compounded, assuming the revenue growth's at a certain crazy rate and price to sales multiples go to a certain place. And then on top of that, you look at the freaking operating cash flow, free cash flow. It's really not that good on a fundamental basis, okay? It doesn't really matter to me how fast the revenue grows. So that's kind of my opinion. I'm not buying this stock. I'm sticking to index funds. And I'm only going to buy a stock that really has outstanding free cash flow growth, operating cash flow growth, revenue growth, all those considerations. And on top of that, the stock is selling or had a recent sell-off. The only one that I really like right now is Alibaba, but there's a lot of risks there. It doesn't mean you have to buy it. But that's kind of my opinion on Square stock. I'm not buying it, but you can kind of use this chart. And if you want me to upload it, I will. Just let me know. You can use this chart to kind of figure out whether you want to buy the stock now, whether it's reasonable to buy the stock, and whether your growth assumptions are reasonable. That's it, ladies and gentlemen. Like the video, subscribe to my channel, tell your friends about me, and you have a wonderful, delicious day.